Stop scrolling. Surprised? As we head into the final days of March 2026, the greatest wealth hijack in the history of precious metals has just been confirmed. The Iran conflict is showing temporary signs of cooling, and crude oil has pulled back to around $91 a barrel. But instead of a normal market correction, Wall Street just executed a mathematically impossible takedown of your safe haven assets. Look at the data. Gold has been pushed down from its peak to roughly $4,100. That is a 25% drop. But silver? Silver was violently smashed from its high of $121 down to exactly $61. A devastating 50% wipeout. Both are monetary metals. So why did Wall Street crash silver exactly twice as hard as gold? Because they specifically targeted silver. Gold is hoarded by central banks, but physical silver is held by you, the retail investor. They engineered this 50% free fall to trigger maximum panic, forcing you to surrender your physical ounces at a massive discount. As Peter Schiff has been urgently warning, this is not a free market. This is a rigged paper illusion designed to shake out weak hands. But here is the ultimate secret the algorithms don't want you to understand. The silver market is a tightly coiled spring. Because they pushed it down twice as far as gold, the mathematical elasticity means silver is preparing for the rubber band effect. When this spring snaps back, it is mathematically programmed to bounce twice as hard and twice as fast. While terrified retail investors are selling the bottom, institutional smart money is quietly accumulating every single drop ounce. The geopolitical fear might be pausing, but the structural industrial deficit for tech and AI has never been worse. This $61 level is not a crash. It is the ultimate bear trap. If you are a physical stacker, you must hold the line. Do not become Wall Street's exit liquidity. Let me show you the exact forensic math proving why this 50% artificial drop is actually the greatest wealth-building setup of our generation. The fake out is exposed. Let's open the ledger and look at the real numbers. Before I expose the exact mechanics behind this massive 50% silver trap, I need to know who the real critical thinkers are in this community right now. Drop a comment below with your country and your local time. This market anomaly affects every single time zone. Pause the video, drop your location, and hit that subscribe button to join the smart money. Now let's open the case file. When the geopolitical news broke, Wall Street initiated a forced liquidity crunch. They dumped billions of dollars in fake paper silver contracts onto the market in minutes, crashing the price to $61. Surprised. But why target silver twice as hard as gold? Because of the massive industrial choke point. The artificial intelligence rollout, EV manufacturers, and the military-industrial complex are devouring physical silver. Their demand is completely price inelastic. They must have the physical metal to survive. But at $61, the paper price is trading dangerously below the actual physical cost of mining production. Primary miners are operating at a catastrophic loss. They cannot pull silver out of the ground at this rigged price. This 50% crash is a psychological weapon. Wall Street created a terrifying illusion to shake weak hands out of the market. They desperately want retail investors to capitulate and to panic sell their physical ounces at a massive 50% loss. So elite institutional buyers and tech giants can stand at the bottom, sweeping up every single physical coin at a severe discount. It is the greatest wealth transfer mechanism ever engineered by the banking syndicate. They are stealing your hard assets to cover their bleeding paper shorts before the rubber band mathematically snaps. And when it snaps, the revaluation will wipe out the short sellers entirely. So I have to ask you, are you going to be their exit liquidity or are you going to hold the line? Drop your answers in the comments, because understanding this liquidity crush leads us to the ultimate science of the rubber band effect. Think of the silver market like a beach ball being aggressively pushed deep underwater by Wall Street algorithms. The deeper you push it below its natural buoyancy, the more violent and explosive the upward trajectory becomes when you let go. Because they intentionally crashed silver 50%, while gold only dropped 25%, the silver spring is compressed twice as hard. But here is the fatal flaw in their paper game. At $61, they hit the physical baseline of reality. The mining supply chain is completely paralyzed. No mining CEO will sell physical silver at a 50% loss. They simply withhold supply. This creates an immediate, catastrophic physical vacuum, but the industrial demands of the tech sector do not stop for a market crash. Data centers and electric vehicle production lines are ravenous. They are demanding physical delivery right now, today. Wall Street can print 1 trillion fake paper contracts to scare you, but they cannot print physical silver atoms to build an AI server. This is exactly what triggers the rubber band to snap. And when the paper illusion breaks, the revaluation is not going to be slow. Silver will not just recover back to $121, the extreme short covering will cause it to violently overshoot. We are looking at a mathematical springboard that will launch the physical price well past the $150 threshold. The institutional short sellers are hopelessly trapped. The only way they survive is if they convince you to sell your ounces to them at $61. If you hold your stack, you win the greatest wealth transfer in modern history. The math is undefeated. But you are not the only one who sees this rubber band effect. While Western retail investors are paralyzed by fear, who do you think is aggressively buying up every single physical ounce at this 50% engineered discount? The true apex predators of the global economy are executing a masterstroke right under our noses. Let's look at the official vault drain data, because what the Eastern superpowers are doing right now will shock you. Look at the Shanghai Gold Exchange and the official COMEX vault data. The numbers are absolutely terrifying for Western banks. As industry expert Andy Schechtman has been relentlessly warning us, the BRICS nations are executing a masterclass in wealth extraction. They are using this engineered 50% crash to ruthlessly drain the West of its physical silver and gold. While Wall Street algorithms smash the paper price down to $61 to trigger retail panic, Eastern sovereign wealth funds step in, buy those cheap paper contracts, and immediately demand physical delivery. They are backing up massive cargo ships and moving millions of ounces of physical metal permanently to the east. Registered silver in the COMEX, the actual metal available to settle these contracts, is plummeting toward historic critical lows. There are hundreds of fake paper claims for every one true physical ounce left in that vault. If this 50% discount arbitrage continues, we are staring down the barrel of a complete COMEX default. They will be forced to declare force majeure, locking the vault doors and handing you a worthless cash settlement instead of your metal. China knows this. They are hoarding physical silver not just for currency backing, but for absolute technological dominance. They are letting Wall Street play their little paper games while they secure the physical assets required to build the future. This is why the $61 silver and $4,100 gold prices are nothing but a giant, flashing neon trap sign. It is specifically designed to transfer wealth from the impatient retail stacker to the informed global elite. But the music is about to stop. The physical supply chain cannot sustain this paper illusion any longer. When the physical market violently decouples from the rigged US ticker, the true price of silver will be unleashed. The rubber band is stretched to its absolute mathematical limit right now. The only question left is whether you will be holding the line when it finally snaps. If you are a physical silver stacker watching this orchestrated bloodbath right now, you need to realize the rubber band is already starting to snap. Because of China's aggressive, relentless physical buying at the absolute bottom, the price could not stay suppressed at $61. Silver has already violently rejected those artificial lows and surged back up, officially crossing the $70 mark today. The institutional short sellers are beginning to panic. This is the exact momentum that will launch silver to its next all-time high. The $61 fakeout was a psychological weapon. It was specifically designed to make you hand your wealth back to the elites. When the exchanges finally halt deliveries and the physical shortage goes mainstream, this market will gap up faster than you can log into your account. So I need to ask you directly, what is your exact strategy as we enter this explosive new phase? Are you holding the line and protecting your physical ounces, or are you letting the media terrify you into capitulation? Drop your exact moves in the comments below. Let the algorithms and the institutions know that this community will not be shaken out. Make sure you hit that subscribe button and turn on the bell notification immediately, because we are tracking this historic vault drain, the rubber band effect, and the march to new highs in real time. The $61 trap failed. Silver is already at $70. I will see you in the comments right now.